Welcome, Dan. Welcome.
Hey, buddy.
So look like you're live on your end.
It looks like I'm live.
All right, folks, we are trying this on both of our channels. So you're going to see our live stream here on Dan's YouTube and on my YouTube and Dan's LinkedIn and his Facebook page. So
Sweet.
We are reaching out everywhere this morning. Welcome. And you're cold there in Chicago.
No, it's freezing. My wife just called me and we got smoke coming out of our bathtub up in the upstairs. And I'm like, well, go downstairs and see what's going on. It was the first time our heater kicked on. So I'm sure there's some dust or dirt or whatever. So if you see me run out of here real fast, that means my house is on fire.
That can't be comforting.
Yeah.
Oh, it's just smoke out of the bathtub.
Yeah, she FaceTimed me and it's like, there's smoke coming out of the tub. And I'm like, well, I'm 20 miles away. What do you want me to do? Oh well. But we all have our problems. Happy Monday, buddy.
Yes, absolutely. We got some questions pile up that we're going to get to here pretty soon. And I had a question for you, and
yes,
and I really want to look at the new builds, because they're doing really well because they buy down your rate. And you and I were discussing the fees now to buy down your rate, and they've gone up exponentially, which begs the question, how are they continuing to afford this? And do we think that will continue? Because we're at 7.8 out on the street, right? And they were offering like 4.9, 5.5. What do you think this is going to slow down? Where are they getting the money? What's your guess?
Here's what I don't know. And that's, I'm not trying to cop out on that one. I just don't know. And it's many times, and I say this, I think, on every video we do. I even tell my kids, it's okay to say you don't know. So here's what's happening. And I don't know how. It perplexes me how it's legal. So and I get this every day. Like I already had 2 emails today. So if you're out there, you're using a builder to build your home. Many times when they do the financing piece of that, they have unbelievable programs that can't be beat. But the problem is you have to use their preferred lender that they usually own a big chunk of. So how they do a lot of this stuff is, the only thing I can think of is how they actually can afford to buy down your rate to be competitive is, over the past year or so, you've saw a lot of new construction is still ticking away like crazy. But a lot of their cost of goods has gone down dramatically, like lumber prices. Lumber prices, I think, are down like 400% or something crazy like that. So the only thing I can think of is, they're using their excess profit margins that they have on your house, because you already contracted, a year ago to build this house. They're using the excess profits to actually roll over and, buy down that rate. The concern or the issues I have is, and we have Julio Jarina, he might be able to answer this, is how is it legal that you can basically, as a builder, you can go out there and say, okay, well, if you use my preferred lender, we're going to give you $20,000 in lender credits. But if you don't use them, too bad. And it'd be like me saying, okay, I can get you this rate at 4.99, but you have to use Rick if you're buying your house. If you use any other realtor, you can't use that. I would be in jail the next day. So that's where I have an issue with that. But if it's helping people buy houses, okay, great with that. The issue, I guess the question that you had is, how are they doing it? That's the only way I can think of how they're doing it. So I don't think they have a coffer of money sitting over here that they want to use to pay, people that they're buying their homes to keep their financing, because you'd be burning money. But then on the other side, it's just a ledger entry. If the builder owns the real estate or the mortgage company, they give you a $20,000 credit, goes over here, they take that credit and they, put the transaction together. Are they really, is it a line item entry, or are they really buying it down? Where's the money coming from? What the concern is, why can't you say, okay, I don't want to use your lender, I'll go with Dan. And why can't I still get the $20,000 lender credit? So in the long run, answer to your question, I don't know how they do it. I don't know how it's legal. If I'm building a house right now, and a lender or the builder offered me those incentives, I'd take it all day long. And I have people sending me their loan estimates and their sheets every day saying, here's what I got. They're giving me a 4.99 rate. Take it, take it. I can't beat it. Nobody in the whole country can beat it. And that's the tough thing behind this, because it's basically, it's not fair competition, I guess, is the best way to put it.
And I see it in a lot of different segments in the real estate industry, like Open Door. If you're buying a house from Open Door, you have to use their title company. And I don't know if they own the title company or they're just affiliated with them, but you're required. Now, if I tell you, Dan, I'm going to write this offer for this house, but you have to use Fidelity, I can't do that. I have to say, well, who would you like to use? And sometimes people list a home and say, we prefer to use, la title company. And so, we don't get to do that. But yet in new builds, they can. And you got an example right here that says good or bad deal. I got an FHA loan fixed at 4.375. Wow. But look at the percent of loan points. The loan is 559,000. The builder's giving him $21,439. Total origination fee, 26. So the builder's coughing up the 21. Now, like you just said, he can't say, well, can you just lower the price of the home by 21,000? They're going to, no, this money can only be used to buy down your points.
And that, the environment we're in right now, rates are 40-year highs, and we know why. I mean, there's two big pieces of this puzzle. The whys are the Federal Reserve just keeps raising rates and raising rates and raising rates, making everything more expensive for everybody, pushing up, rates on everything. When's the last time your savings account or a money market account was yielding, 5 or 6%? That's why I'm still astonished how the stock market's still doing well, because you can push money into a secured asset with no risk and make 5.5%. Or you throw it in the market and you're like, okay, historically it gets 8-9%, but you have risk, so it's a tough market out there right now. Then you have the government shutdown, and the government is just printing money like drunken sailors. They're trying to fund every little piece of everything. And then, I come out sometimes and I'm critical of some of these things that they do, helping foreign countries and things like that. And I know we need these things. Don't get me wrong. I know we need these things. But the problem is, even with the student loan stuff and everything else, this money has to be, paid somehow, like the student loan debt. The colleges are getting their money, so if the students aren't paying it, where's it going to come from? Well, it's going to come from the government coffers. What's the government doing right now? We're in a deficit. How do they pay these bills when they don't have enough cash coming in to pay the bills, even the interest that's going out? Well, they have to sell bonds. Bonds are now hitting Wall Street in record numbers. And it's causing, everything, it's causing everything, all yields on everything to go way, way, way high. And as the government continues to do this, spending and spending and spending, again, we have no money in the government. And I'm not just crying wolf. Look at our deficit. We're at 33 trillion, I think it is. So that means we owe $33 trillion, and it grows every day. If you keep giving money away that we don't have, that national debt's going to go up. The way you finance it is with bonds. You throw more bonds into the market. Now you have a glut of something. So it doesn't matter what you have. If you have a widget, you have an apple. If you have 50,000 apples that you want to sell, well, you're hoping to get a penny per apple. Now, if you have 10 apples to sell, well, the price of those apples are going to go up to $10 or to the highest point that somebody's willing to buy it for, So what I'm getting at is the more of something you flood the market with, the prices are going to go down and down and down, because that's just how everything works. That's how house prices crash. Why did the housing market crash in 2008? Way too many houses on the market because people were getting foreclosed on. So you have way too many of something pushing down the prices of things. Well, in the bond market, how it works is as the prices of bonds go down, rates go up. And that's what we're seeing right now. The government's overspending. The Federal Reserve is in complete tight mode. And it's just a perfect storm of, just terrible, terrible rates. Like Michi said,
supply and demand is it's the same as real estate, right? It just, and China and Japan are not buying our debt at the rate that they used to. So I always call the treasury's trying to refill their checking account.
Right.
Because after
Yes.
the government shutdown, they had to hurry up and raise $1 trillion.
Right.
You know, a billion here, a billion there. Pretty soon it's real money. And so they do that by issuing bonds. Well, now you're issuing bonds from the Treasury, corporate bonds, okay, and then mortgage-backed securities. And there's so many bonds out there and so few buyers that the demand is, I mean, not there. So the
Right.
rates just keep climbing. So people are looking to go, well, when's the Fed going to pivot? Well, the Fed could pivot all at once now, but the government still needs you to buy bonds.
Right. Yep.
So I don't know how long we're going to be in this situation, because the interest on our debt now is right there with the cost of national defense, $76 billion right now.
Yeah.
Staggering.
Yeah. So, but, and it here's another thing is, with the Federal Reserve, what they control, what a lot of people don't understand is they control what's called the federal funds rate. It's not the mortgage rates. It's not your car, it's kind of like your car loans or whatever. They control one thing. It's the federal funds rate. What the federal funds rate is basically at the end of the day, if a bank doesn't have enough in the reserves that they need or required to by the FDIC to shut their doors, they need to go out and borrow money. So they borrow from another bank or the Federal Reserve, and that rate is the federal funds rate. Okay, that's it. That's what the federal government or the Federal Reserve, that's what they control. But once that cost goes up, short-term maturities also follow suit, such as car loans and everything else. So right now you have short-term debt, short-term instruments at skyrocket high rates. That's when people talk about the inversion of the yield curve, it basically means short-term rates are higher than long-term rates, which should not be the case. Because what you're doing with your money is, if you're saying, okay, I'll invest something for 30 days, I want a return. But if I'm going to lock up my money for 5, 10, 20, 30 years, I want a bigger return because I'm locking up my money. Right now, you can lock in your money with a 6-month CD at 5.5 rates. That's crazy. It's fantastic for us that, anybody looking to save some money. But on the long term, that means, well, now you can get short-term rates at 5.5%. Well, that's that's a secure instrument when it comes to interest rates. Okay. So I can put money into a CD, 100% secured at 5.5% rates. Okay. So now why would you buy a mortgage bond at 5.5%? If there's risk there because of mortgage default? So people are electing, I'll just take the CD at the secured rate. It's a better rate than I've been getting in 40 years. I'll just put my money in short-term instruments. So that's what you're seeing right now. So all this stuff is basically the perfect storm for what you're seeing right now. So will it calm down? Yeah, it'll calm down. When? Don't know. But right now we're starting to see inflation. A lot of things are taking a toll. I talk to probably 7 to 8 people a day that are looking to buy homes. And their biggest thing is, just with the cost of everything. Now we have student loan debt kicking in, an extra $300, $400, $500 a month that people didn't have. Interest rates at sky high interest rates. Now you're starting to see a lot of the cracks in the foundation, and you're going to see it continue. So the Fed's, the inflation numbers at some point, they're going to look at it and say, whoa, those drop fast. Well, it's going to happen. And a lot of analysts are saying the same thing. Wall Street is actually at the point where they're now priced in the higher rates for longer. So that's why you saw a hiccup in the stock market over the last 60 days because of that. But now it's priced in. So you're starting to see things somewhat settling down, but then you have government shutdown around the corner. Now you have Hamas bombing Israel. Now you have all this stuff going on, and it's just like it's a crazy world out there right now. So
question here, Mark, I'm not sure I understand it though. Question is, where is all the extra funds going toward now that rates have gone up?
There is no extra, Mark, great question. There is no extra funds. Basically, what we're trying to figure out is how the builders are actually getting a rate that is way below market. So for example, let's say today, and the headline news is, rates are 7.8% or whatever. That's kind of, we're a lot of people that we're talking to right now is we're suggesting an FHA loan. FHA rates are about a half or three quarters lower than conventional financing, and that's normally never happen. That's normally not what happens unless you really have bad credit. But you can have somebody with a 780 credit score putting down 20%. They're getting a higher rate than if you were to go with FHA putting down 3.5%. So it's a crazy market.
Yeah, and I made a comment on a show last week, and I think I got another video coming out in a couple of days saying everybody's looking at 2008. Everybody's looking at 2008. If you really want some historical perspective as to what our situation is now, which is trying to bring inflation down with an increase in rates, then you have to go back to the 80s. And lo and behold, yesterday I read in this article, buckle up for more turbulence in the housing market. Bank of America says it's a housing recession, 1980s style. But here's the interesting thing. It goes on to say, once again, this isn't 2008, but it's saying that there's no noticeable signs of excess housing development today like there was back then. There were a lot of builders in the 80s.
Oh, yeah.
And households aren't nearly as burdened by mortgage debt, current debt. Household mortgage debt represents roughly 65% of U.S. consumers' disposable income in the second quarter, compared to 100% before the great financial crisis. And the ratio of America's mortgage debt to their real estate assets, called loan to value, was just 27% in the second quarter, compared to 40% in 2008. And I always question those 2008 numbers anyway, because it shows the prevailing rate, but hardly anybody was paying the prevailing rate. They all had 0% or interest only or 1%.
Yeah.
And even though the rate was hovering around 7%. So, but in the 80s, real estate stayed flat.
Yeah.
As things are being pulled back and interest rates went up to 18%, real estate remained flat. One of the reasons is I'm a baby boomer, and we were in prime purchasing mode back then. Even though everything went to hell, we still wanted a house. We were going to have a kid, and my friends wanted a house, and we were all buying. We had good jobs.
Yeah.
So, and that's what we're seeing now, except the people that are in prime buying mode right now have too much debt. They have high car payments. They have student debt, and they're giving up. And so, but they're still spending. So they're giving up saving for a house, but they're still spending. That's when you're also seeing credit card debt starting to come up.
The foundation on the economy piece is going to crack. And the Federal Reserve keeps doing this, but it'll crack. But if you go back to the 80s, and this is where I'm still on that side of the fence, that there should not be a housing crash. It's just not in the cards. Everybody that pivots, if you go to the TV and YouTubes and whatever, when you really start focusing in on real estate, their pivot point is 100% always 2008. Well, in 2008 it crashed. Well, we're not even, okay, how about 2010? Okay, what's the difference between today's economy and 2010? Because what I'm getting at is it's not 2008. 2008 there was so much crap loans out in the market that for people that financed 100% and should never even been able to buy a house, that when those houses when everything imploded at that time, everything crashed. Again, if we're in the market right now where everybody had an adjustable rate and it adjusted every year, and now your rate went from 3% 3 years ago, and now you're currently paying 7 or 8%, you'd see tons of homes on the market. You'd have houses flooding the market, but people have fixed rates. So that's where, it's still, if you try to debate this with a doom and gloomer, I always say it's not even close to being the same. Almost probably 90% of people have a fixed rate below 4%. It's not going to change. It won't change. It's good for 30 years. So a lot of times if you're watching, it depends on what you're watching, you're thinking, oh man, if I buy a house every year, my payment's going to go up. That's what these guys are saying. It doesn't. Well, it does a little bit, because your homeowner's insurance might be going up and your real estate taxes might go up a little bit, but you're talking maybe $100 a month. not in the tune of where it was in 2008 when your payment went from 1,500 to 3,000 to 4,000, and you're only making 4,000 a month. So what do
Yeah.
you do?
Yeah.
Well, I can't afford the house. I can't do anything. I got to sell this thing. So you have to sell the house. In today's market, people, if you own a house right now and you've been in it for 3-4 years, you're in the catbird seat. You have a fantastic rate. Your payments are low. You're not seeing the inflation, bubble on that side of the equation. Yes, your gas prices are going up, utilities, food, and everything else, but your housing costs, your shelter costs is basically stagnant, and it's an affordable payment. So that's where, it can kind of the hair on the back of my neck stands up when everybody keeps pivoting around 2008. Told you 2008. I told you houses are going to crash. But then when you bring it up, the talking points, they always, San Diego's crashing. Well, yeah. Hartford, Connecticut, it's up 10% this year. So you get what I'm saying? The overall market's just completely flat.
Well, here's a chart that I ran into from our friends at BAM. And I want to blow this up just a hair here. I love this chart, Dan, because right here, you can see where my mouse is. See all that green? That green is 2020, 2021, 2022. And this is the number of mortgages that are out there that are below 3.875.
Well, look at the one that goes all the way to the right.
Yeah, that's 2020 and 2021.
2.875.
Yeah.
So that person, anybody, if you bought or refinance in 2020, 2021, you're locked in, and you're probably not going to sell that house for a long time. You could probably cash flow that thing by renting it out.
Well, look at all the people that refinanced from 2010 to 2014, which is the light gray numbers right here. They're all down below 5%.
Yep. You go right
so
there.
The people that are crying the blues right now are the ones that just bought in 2022 and 2023. These numbers right here. But here's I think the common comment I get a lot of. If homeowners see a decline in equity, they'll likely consider selling regardless of rate. Why? If I'm in a house and it's worth $500,000 and I check the value on my buddies at Zillow and it's down to $450, why is that a sell signal?
Yep. Bring that up again. Bring
that shelter.
Bring that up again if you would. So I think we're starting to have people that on the other side of the fence. Maybe I could be wrong. So I'd love to have the debate. And this is this is the format I love, because so many times the people kind of hide behind maybe just a post on YouTube or whatever. So if you're a homeowner sees decline in equity, like my house, did my equity go down the last year or two? I don't know. I don't really care, because I have a shelter cost that is more than affordable. I'm in a market that I don't have to sell. So why would I sell? So they'll likely sell regardless of the rate. The equity isn't real until you sell or tap into it. Credit card debt is high. Agree with that. Consumers need more cash. Agree with all that. So I'd agree with all that, but I would disagree with your analogy that they're going to sell because their equity dropped a little bit. When you buy a stock, you ride it up, and as soon as the stock price goes down a little bit, are you selling? Probably not. You're in there for the long term. That's housing. That's shelter. Your shelter isn't Bitcoin. It's not a tradable instrument. You get into it, make it affordable payment, and hopefully over time you gain wealth by owning that property. But if you're going to trade your house like you do stocks or bonds or cryptocurrency, God bless you, but you're probably going to lose almost every time.
Yeah.
Another one, the payment for the house is not stagnant. Remember, real estate taxes. Correct. And I did address that. So I'm not hiding behind that. I never say, you're going to get a house payment and that house payment will stay steady for the rest of your life. I always say your real estate taxes are going to move. Sometimes, like in Illinois over the last couple of years, believe it or not, my tax bill went down a little bit. Okay. So, but now it's coming back up. My homeowner's insurance, that actually was up. I actually went out to a insurance broker friend of mine. I finally said, okay, let me see what you can do for me. He actually reduced by bundling my insurance. I sound like a commercial now. He's saving me over $2,600 a year in my insurance. Okay. So now my overall housing payment went down. So you always, a lot of people just post out there the, the doom and the gloom and you got to sell and whatever, but it's not,
Well,
it's not a relative argument.
Dan, your landlord's taxes go up too. And what do they do with the taxes when they go up?
Increase your rent. Same with
So
the homeowner's
it's not
insurance.
like you can escape it.
Yep.
It's an unfortunate look. Inflation's a bad thing. It hurts you in every corner, but it doesn't. And sometimes a lot of people run up some credit card debt. I mean, you got to be smart with your money. Sometimes people lose their jobs. That's always going on. If you have millions of people losing their jobs, then yes, people
absolutely.
will be forced to sell. There's no escaping that. And we got the pandemonium. Got to head to work. Thanks for the chat. Thanks for joining us. Megan here says institutional investors own 25% of single family homes in America. They are more likely to sell as the economy declines due to needing increased liquidity. All depends on whether or not their cash flow goes. The majority of the investors bought during that really low rate environment right around here, and their cash flow is good and rents are not coming down. So they're hanging on with the good rental income. So their choice is, do I sell that rental income property and put it in a 5% CD when I'm already making 10% return on my money holding the rental? So all of those dynamics have to change. And I just don't see that them just dumping the market like Airbnbs. Or Airbnbs are going to crash and everybody's going to put them up for sale. Good. I don't believe it, but good. If they do, if all of the Airbnbs in Arizona went on the market, we still wouldn't be at normal inventory levels, and they wouldn't stay on the market because they're such good homes. Airbnbs are fixed up really nice. They're in great shape. And now Megan is correct here. They'll need to make up for losses in commercial real estate. Commercial real estate's in trouble. Why? Because most commercial real estate is adjustable rate mortgages and notes, whereas our housing isn't. So are the companies that are investing in commercial real estate the same one that own the rental down the street? Maybe some. So the fallout from a commercial real estate debacle or crash will be something interesting to follow, but I don't know. I mean, they're just going to walk away from the commercial real estate. They can still hold on to their residential rentals. But,
I mean, you can,
they're tangled up together. So we'll have to see how that all unwinds.
We can banter. Megan, thanks so much for posting, but we can banter back and forth the issues. But many times when I'm trying to debate somebody on some of this stuff, they just keep throwing negative stuff. And then as you hit that ball, they'll throw another one. And then it's like, well, the taxes are going to go up. Well, maybe they won't go up. And then you hit that ball. Well, maybe the commercial market will crash and maybe then you hit that out. And then they'll crash. So if you're one of the dooms and gloomers, you're like, okay, it's just the market's going to crash. Kudos to you. My goal here is, and Rick's goal is, we just want you to know the facts behind everything. I'm not saying it's right or wrong. I'm not, debating one side. I just want you guys to understand the dynamics behind all this. A lot of times I like talking about mortgages. A lot of people would, but my goal is I'm a mortgage advisor. I'd love to talk people through these times right now. There's programs out there that can help you get into homes. There are people still looking to buy homes. The Midwest, the central part of the country is, Ohio, Pennsylvania, Indiana, Michigan. There's still areas that are affordable, but a lot of times, people use the talking points of, well, the markets are crashing. Look, San Diego. Well, I'm in San Diego, so I have to talk about San Diego. I'm not, but they'll come out with that and they'll tell you how bad San Diego is. Well, yeah, I know, I'm not hiding that either. It's bad. But you go to, Dayton, Ohio, you can buy a $225,000 awesome home with $1,200 in taxes. So if you're a remote worker and you want to find somewhere to live that you can afford, move to Ohio. There are affordable homes. No, you can't live in San Diego. I couldn't live in San Diego. It's too expensive. We're getting contracts in from New York. Small 900 square foot homes are going for, $900,000. It's like, are you kidding me? But conversely, they're making the money. I have one young lady right now I'm working with. She's originally from Utah. She moved to California because she doubled her income. But she's going to buy a house in Utah. She's going to work 5 or 6 more years, retire, and then go back to Utah. And it's fantastic. But she moved
Works.
to California because she could double her income. Cost of living is way, much higher, but that's what she chose. So a lot of people, when they were remote, they're moving all over the country to find that ideal place where they want to live. Austin, Texas. Why did Austin, Texas blow up? Well, that's where all the millennials, they want to live because it's cool. It's a great city. It's growing. It's building. But now this, again, we go back to supply demand. You have huge demand in that area. What's going to happen to the prices? It's going to skyrocket. Well, that I even said in my, at the beginning of the year, I was predicting, I'm like, the market is going to be flat as a pancake, but you're going to have Austin and those areas down here because you can't substantiate, 20% increases in values over, every year. And then you're going to have areas up here that just, didn't do anything, like in Illinois. We're up 5% this year. That's where I live. My house didn't go up 20% last year, went up 5%. So those are what you see. So when you're out there saying, I can't afford here, well, maybe that's not where you should be. I hate to say it that way.
Yeah. It's if you're priced out of Seattle, get out of Seattle. Sometimes you need to move. We have Miranda's asking a question saying, what about these new home buy downs? What rate will their mortgage adjust to eventually? They're buying down the rate for the whole term.
Yeah, it's a fixed rate. It's a fantastic deal. I don't know what all builders do it. I don't know how they're doing it. I don't know where they're getting the money. Somebody, I think, I was reading some things through here. They might had a bunch of money in their coffers and they're using it up, where they might have pre-bought, or they might have did like long-term rate locks on a lot of these things. And when those lapse, what's going to happen? I don't know the dynamics behind how the builders preferred lenders do this. So I can't speak on that.
Chris has a question here, says, or a statement. I own my home 2013 buy and couldn't cash flow. I have to live somewhere else. And that somewhere else, the rate eats up all the cash rental income, 2,500 interest only on the new home, 4,000 I must sell. So you've got an interest only loan.
I own my house and couldn't cash flow. I have to live somewhere else, and that somewhere else eats up the cash. Rental income 2,500, interest only on the new home. I must sell. I kind of get it, but I don't know how you structured that loan. I don't know how in 2013 you bought it. That's 10 years ago. You should have refinanced back in 2000. Got lock in a rate at 3%. How that wouldn't cash flow, I don't know. Can you bring that up one more time? Maybe during, and I'll ask this, Chris, if you don't mind plugging this in. So up until now, have you had, like in the last 10 years, did you have like unbelievable cash flow? And now because you took an interest only, maybe adjustable rate, that's what's really affecting you right now. So that might be your scenario. I'm not sure.
Yeah, I need a little more clarification there. Tanner here saying, when rates go down, won't prices go up? Date the rate, marry the home. I don't like that industry term at all. Too many people grabbed it, marry the home, date the rate. And it just ended up being an industry tagline. Yep. And basically that's saying, buy the house, don't worry, the rate can change. You can refinance. If you're a risk taker, go ahead. I don't know. Yes, if rates go down, prices will go up. But again, all indications from what we're just seeing on the short term now, and I'm just spitballing here, I think we're going to be talking about this next year. It's going to be the same. We're going to be in this a while. And just like the 80s, that didn't ring out in a couple of months. It just took its time. And like Megan here says, I don't think the market's going to crash. I think it's going through a correction. I just think investors are the reason for the price spike. Doodle and buying 80% of the homes that I'm buying in. And she says, I totally get your arguing is annoying point, though. Thank you for expressing your thoughts.
Megan, I'm not here to make you mad. I'm just here. Sometimes just, I guess I'll be like dad. It's hard love, I guess. I'm just trying to, to understand. And a lot of times when you guys are looking at things, you might just look at your market, your individual market. Okay. So I get that. But then also the country's huge. I mean, it's huge. So again, I see houses in Ohio, Indiana. Maybe you don't want to live there. Okay. But if you're asking, where are houses affordable? Where can I buy? Where's, that there's great value in those areas. Stay out of Austin, stay out of San Diego, stay out of, areas, not staying out. If you can afford it, God bless you. But so that's where we're at. You want to
Yeah.
flick through some of the questions and we get to them?
Yeah, I think we've got, firefighter here just is saying equity is not a sell signal, especially in a market where they continue to raise over time. I tell people, treat it like your 401k. Don't look at it.
Yeah.
I
Yeah.
mean,
Just make sure
you
it's
got to
in.
look at your monthly payment
Yeah.
when you make the payment, but
Yeah.
don't worry about the value. Sit down and then ask yourself honestly, what is my equity going to be in 10 years?
Right.
Not today, not next month. If you already own the house and you got a payment you can live with, yes, you've got some adjustments being, and that's the nice thing about if you can get in. Now, I get it. You don't want to get into where you're so strapped to where if a bill goes up, like right now, gas, but you can't afford a higher gas bill because you're so maxed out with your mortgage, your house poor, try to stay out of that situation.
Right. Yep.
But if, to Dan's point, some parts of the country are very affordable. And so if you really want answers to some questions on types of programs that are out there, or just, what's it like to get a loan, we have links in our description, and it says, you can just click on it and they'll give you a call and say, well, here's what we got and here's how the whole process works. You may want to wait 2 years, but in the meantime, get your credit straight, pay off your debt. If you do believe the prices are going to adjust, and they more than likely in some parts of the country they will, or most of the country, then be in a position to take advantage of that. Douglas here says taking higher paying remote type job to another state has partially contributed to the inflated home prices in markets where it's not natural. What contributed to it was free money.
Yeah.
I mean,
But he was on point
right.
too. I mean, I had people moving all over the country, and I'm like, okay, because normally if you're moving from Maryland to Texas, the first question I'm going to be is your job transferring? Are you, getting a new job? Do you have a job already lined up? And it was at the point, and it blew my mind in 2021. It was like, no, I work remote, so I can work anywhere I want. And I'm like, that many people work remote?
Oh,
and
it was
they do.
unbelievable. Yeah, but
But
so, Amazon burned a lot of people. They're calling them back now.
Yeah,
I have a friend whose son has got a pretty high position in with Amazon, and he moved to the other side of the state and bought God knows how many acres and built a beautiful home out there. And they go, well, we need you back to Seattle 3 days a week. He's got to drive over a mountain pass, drive 3 hours to get to Seattle.
Got it.
And he's saying, well, no, I mean, I can't do more in the office than I can do here. You still got to come back.
Yep. Doesn't matter.
Yeah.
Take a higher remote job. Did we get to most of the questions that we have out here?
I think we did. We did. So
Megan, I want to applaud you for coming on here and speaking your piece, and everybody out there. Here, let me just explain to you what we do. So please don't turn off the dial. So if you're out there and you're really looking to buy in this market, because we're still getting contracts in. We have people, like I said, we're not getting as many in, Southern California, parts of Florida and things like that. But people still want to say, can I qualify? Because hate to say it, the horror stories I get when it comes to people renting, they're out there. So let me explain what we do and how we do things. We're all over YouTube. We have a huge social media platform. Our goal is to educate you guys out there. We are actually a federal bank in Illinois. That's where I'm located. That allows us to lend anywhere in the country. Okay. But the unique piece about what we do, and I've been doing this for over 30 years, the unique thing of what we do is we're also one of the country's largest mortgage brokers. Okay. And here's how this works is you don't no longer need to, go out there and get 10 pre-qualification letters. Because the system works like this. You put in an application and somebody pulls your credit. Okay. And then you go out there and we analyze that data. And then we take that data, just like every other company out there. I don't care if you're going to Rocket Mortgage or Citibank or Chase, Wells Fargo, whoever, they're going to send your data to Fannie Mae. and or Freddie Mac. Doesn't matter if you know who either of those are, because they approve 90% of the country's loans when it comes to conventional loans, FHA, and VA. Okay. So if you got an approval, in most cases, all the other places can get you approved. So now here's the unique thing that we have. We then go in and we plug in your data into this system that we use, and it's going to scan the whole country. I'm set up with just a little less than 80 different of the country's largest lenders out there. So we're going to do your shopping for you. We plug in the data. It's going to list all the mortgage companies out there. A lot of them are the places you're going to be calling. And it lists them out. And so then I can, in an instant, I can see who's got the best rate in the market right now. Okay, so here's what most people do. They'll start, they decided over the weekend that they want to buy a house. So Monday, they start applying for loans, and then they get a quote. Then they apply on Tuesday somewhere and they get a quote. Then they apply on Wednesday, they get a quote. Now they find a house, put a house under contract. Now they're like, okay, now who's got the best rate? So they call the first place back and they get their rate. Then they call the next place back, but they got tied up at work. So they call the next day and they get a quote. Then later that day, they call another company and they get a quote. Then they find out, well, the first person I called, they have the best rate. So they call them back and they're like, well, yeah, that was the rate at that time, but rates changed. So now you're just chasing your tail. Okay. So what we want to offer or introduce you guys to is us. We can get one credit pool, one application. That'll get you started. We're going to upload your information into Fannie Mae and Freddie Mac. We're going to get you pre-qualified, pre-approved. Then from there, leave it in our hands to moderate the rates for you on a daily basis so we can catch that drop, once you find a house and put a house under contract. That's what we do. So many people are they keep calling and checking and emailing and whatever, just trying to find those rates. It's like you want to buy a stock. And you sit there and it's like, I don't know what I want to do. Well, 2 hours later, that stock price changed. You missed it. If it was at a good price that you liked. So that's what we want to educate you guys on. This is what we do. We have a link down below. If you want to check us out, and we go through consultations with you to go over your numbers, go over your situation. Can you really get qualified in this market? Is it a payment that you're comfortable for? That's what we do, as well as try to educate you on all the programs and everything else that you would qualify for. So sorry, that was my 2 minutes.
I see it a lot. People go to one of these online places, and they'll click and they'll get a rate quote.
Yeah.
And they go, well, we can guarantee that. What they don't tell you is, well, we can guarantee it, but we can't tell you what your fee is for a couple of weeks.
Right. Yeah.
Say, oh, I can get you at 6.9. Wow, that's super. Well, by the time you're getting ready to close, to get you at 6.9 is going to cost you 10 grand.
I just got somebody just emailed me a quote just now, and it was, it was kind of like, here, I'll tell you what it is. I'll give you and I won't tell you the name or anything. The rate, I asked him, because he's like, they're giving me 7.625. I'm like, okay, well, that's pretty darn good rate. You know how much it cost him in lender fees, just lender fees and points and whatever, just lender, not the legal, not the title fees, not almost $10,000
to get to 7.625.
Yeah. Yeah.
So okay, now if that was an online lender, I guarantee you, they're just going to tell you, I can get you 7.625. They're not going to tell you about the 10 grand until later.
Well, that was just the points. Now they also charged 14, 15, 1,600 in points. So it was 9,700 plus 1,600. What's that? 10, 11, 12, $12,000. $12,000.
Yeah.
So ours in that scenario would probably be there's no underwriting. Their underwriting fee was $700. Their admin fee was $700. Tax service fees and points, $12,000. Ours, I don't know the scenario because I emailed the person back. I said, what's your credit score? Because all these things come into play.
Yeah.
But again, and then they offered him 6.9 and it was $25,000 in fees. Like, well, so I get a lot of times, like you were saying, I can get 6.95. Fantastic. Well, how much are they charging you for it? You got to pay attention to those things.
Yeah.
And that's where
fees.
9 times out of 10, I beat. Like this one, I haven't quoted him back yet, but I can usually, clobber these things. But the weird thing is then many times the person will go back to that other lender, or they never even call me back. And I'm like, I had one last week. I could save him 13,000 in points. 13,000. Never call me back. I'm like,
yeah.
What do you? I mean, if you want to spend 13 grand, I can give you a rate that's 1% lower. So I don't get it.
Check that one out. 7.3 with 42,000 in
Yeah.
closing costs. Sign me up.
So
I don't know anything. We got a question here too, Dan,
yeah,
about Dallas market. I only know Arizona. I don't know anything about Dallas too.
I don't know specific Dallas. I just spoke with two people today. One was looking to buy in San Antonio, and one was looking to buy, shoot, I forget where else. But I had two consultation calls so far today, and the wild thing is they're both in Texas. So Texas is still a hot market for us in many areas. There are parts of California there. I talked to a couple of people yesterday in California, the areas that are priced. You can live there as a normal person, but we're seeing the most value in homes right now is like the middle of the country, because
Well, you
nobody.
weren't insinuating that you have to be abnormal to live in California.
Yeah. you know what I'm saying. It's like if you make normal wages, if you're out in the techie world, you're making, 100,000 a month, these rates aren't affecting you. But, common people, these rates they're hurting.
Well, I like to, if you come back to my channel, just let you know what I do. I just look at Arizona data. I don't go out very far. I don't make long-term projections. I'll comment on them, like, yeah, well, maybe we'll do that, maybe don't. But if you really want to see the current inventory, the trends, I do a 7-day moving average. I can tell you that our sales are down as low as they've ever been. Our inventory is just barely creeping up, 300 to 500 homes over a 7-day period, which is not huge. It's still way below where we've been. And so we just watch it and we look at it and we look at different parts of the town. How is Chandler doing? How is Scottsdale? What's this price range doing right now? I got a comment this morning on a house in Apache Junction was priced at $1.3 million and lowered it to $999,000. So I know prices are going down. And I'm like, yeah, what, because of one house? So we look at the whole market.
Yeah.
And now there are people that will put a house out there thinking it's worth 1.3 million and finding out it's not. That doesn't mean prices are adjusting and coming down. It
Right.
just means, oops, I shot for the moon. It didn't work. So it's important to walk away from the anecdotes and the stories from your neighbors and really understand the numbers, the math of what's going on. So when I see somebody saying Phoenix is down 15%, I just saw a video on that. I look up the numbers. Well, let's look. Oh, actually, no, we're flat to last year. We're down 1% from last month. So that's a far cry from somebody telling you that Phoenix is down 15%. Not even close.
Right.
We were in 2022, but guess what? We made all that up. And there's charts that show that. And so if you're thinking of buying or selling in Phoenix, I said, September and October, if you're thinking of selling, might be your best time. But that window's kind of closing, and not closing because I think your house price is going to crash, closing because the volume's really starting to go down now as we get into November, December. I think this is going to be the slowest November, December we've ever seen.
Yeah.
And that's slower in volume, way back to the debacle in 2008. So, it's the industry's going to have a tough time as we march towards hopefully affordability, but I don't know. But Dan, I want to thank you for coming
betcha,
on,
buddy.
and we're both doing this on each of our channels. I'd like to do it again next week. And people, if you're not on the live stream and you're watching the replay, let us know if there's anything you want us to cover, and we'll come back on and do this again. How's that sound?
That's perfect, sir. Yeah,
Now,
leave
go
comments
home and
over
make
there,
sure
and we can bring
Go
those
home
in.
and make sure your bathtub's not on fire.
Yeah, seriously. All right, man.
See you,
Take
Dan.
care. And thanks.